Hey traders, Raghee here, and in this free recap video we're going to cover gold and the dollar, two very popular symbols that are watched amongst futures traders and stock traders alike. And I think they're telling a pretty interesting story right now, and I'm going to talk about the zones that they're in right now and what we're doing with them. So first of all, let's start with gold. The daily chart is where the setup is, and the daily chart is in what I call a distribution chop. In fact, it's not just what I call it, that's actually what it is. So when the market is moving in a distribution chop, what we have is a sideways market, not a lot of kind of crispness at what the top of the range or the bottom of the range really is. But you have definitely a range that you can identify. The more confidence you have in the lows of the range, the easier it's going to be traded. But this is choppy market. This is overbought, oversold stuff. So one of the things that we've been looking at, and this is an alert that we've had running for a while, and that is buying this zone right here in gold. By the way, this is the third time we've done it. So I wanted to follow up with this because this was a trend following. It's a trend following. This was an oversold, and the difference between the two, even though they're the same price, the difference between the two is we were trending here and we were chopping by the time we got to this area. So I am once again looking long. Now, it's really important for everyone to understand that you don't have to get long with the GC. So let's talk about some alternatives here. We have the MGC that we're watching. So you can look at that contract, which is MGC, which is the micro gold. We have the GLD, which you can watch as well. So what you have is one micro contract, the micro gold contract in the MGC, the full size contract in the GC, and the ETF for gold in GLD. Now, what's nice about the GC and the GLD, if you wanted to enter with a call option with the bearish momentum into the support zone, which is what this is. Again, same thing on the GC futures contract. If you want to enter long, one of the things I like to remind everybody is, if I don't want to play the underlying symbol, I will not be looking at the option either. So if I'm willing to be a buyer of GC, which is what I'm doing, I am also open to the call option. Now, the call option has some timing and momentum differences. I'm not as concerned with timing and momentum. All I really need to buy GC on the underlying contract is price. A certain price threshold has to be hit, and that's what this is right there, 12.93 down to 12.87. But if I'm going to buy a call option, I need timing, which is I need the price action, that zone, to be reached while we're trading lower into it. In other words, I need bearish momentum into the support zone, and that's where I want to bid on the calls. All right, so that's what I'm looking at here on gold GC. Now I mentioned there's something interesting happening in the dollar, so let's jump on over here. So I'm going to put gold on the left here. I'll put the dollar on the right. So I don't believe in fixed, and I don't believe in correlations unless there's causation. In other words, if there's a reason for the two markets to be connected. Now, it seems that there is pretty decent what's known as negative or inverse correlation for gold. And I just don't look for lows just to sync up. I actually look to see what date this low was made. And does that date sync up or happen in proximity with the lows on the dollar? And actually, they don't really sync up that well at all. You can see that more or less there's some inflection points, but they don't sync up that well. Now, there are some decent highs and lows, but as much as they look like they're coordinating, they really aren't. They really aren't. In fact, you can see here that gold made a high on the 20th, but this high here in the dollar was on the 15th. So I don't want you thinking, oh, well, dollar's leading gold. No, they're both choppy right now, but they're not as synced up as it would first appear. So that's number one, because a lot of traders do look at these two together. So what I'm telling you is there is some similarity in that they're both in chop, but there's not similarity in the timing. However, gold is testing its lows here. Again, we've tested this area 3 times within the context of a trend and a non-trending market. And here, this is absolutely a non-trending market, and here we are reaching up to what I would consider an overbought zone. So dollar has some exhaustion happening around 97, as has happened before, and gold has some exhaustion happening in this area, which is why I'm looking long in gold. And I'm not really keen on shorting the dollar, but right now the zone that we're in is either a target for long positions, or you can think about buying euro, temporarily buying the euro or shorting the dollar. Again, this is really just an overbought short. So let me show you the euro here, and we'll wrap up this video. Now, I am really right now not focusing really strongly on currencies because the volatility, the contrast, is at historical lows, meaning we're under 2% right now in terms of high to low contrast in terms of percentage points difference between the highest and lowest strength currencies, or the strongest and weakest currencies. That is a problem for Forex traders. But if the dollar is at a resistance level near term, I think we do have an oversold euro. Again, it's a quick trade. Don't fall in love with the position. I am overall bearish on the euro, bullish on the dollar, but this is a quick trade zone that we're in. Hope this helps, and I'll see you in the next update.